Welcome to the Bloomberg Markets Podcast. I'm Paul Sweeney, alongside my co-host, Matt Miller.
Every business day, we bring you interviews from CEOs, market pros, and Bloomberg experts, along with essential market-moving news.
Find the Bloomberg Markets Podcast on Apple Podcasts or wherever you listen to podcasts and at Bloomberg.com/podcast. Phil Toews, CEO of Toews Asset Management. He joins us here in our Bloomberg Interactive Broker Studio. And if you spelled your name Toews, no way am I getting Toews out of that.
Yeah, so actually, and there's a V in there. It's like waves of the ocean with a T, so Toews.
Where's that from? Where do you get
German,
so,
right?
Yeah, well, it would have been an O umlaut, which
That's
is
right.
unpronounceable in the English language, and so they converted it to something that people could say, but not like say if you look at the spelling, right? So,
Yes.
Yeah.
Despite
for
that,
example, König or Koenig,
Right. Yeah.
which means
Sure.
king.
Yeah.
It's just impossible, even for someone like me who spent 10 years living in Germany, I can never pronounce the O with an umlaut over it.
Umlaut.
So I think Toews is the only choice.
Yeah, so we're going all in. We're trying to get Lowe's to change their pronunciation to Laves. Like we're on a mission.
Yeah, because I totally skewered your name a little earlier today, but I'm not apologizing because there's no way you get Toews out of that. But I'll go with it. You're in our studio. We appreciate you coming in.
Yeah.
What are you doing with this market here, Phil? I mean, people were just kind of figuring we're going to the moon a few weeks ago, and then August hasn't been so great. How are you thinking about it?
Yeah, so the markets are just big optimism machines. I don't know, do we get that?
Yes.
And so there could be a couple of things that cause a dent in optimism. We all know about China. Rates, I'm not loving the move higher in the 10-year again today up to sort of fresh highs.
Yep.
That's definitely weighing on it. Are there going to be things that develop as a result of those higher rates like we saw back in March with the regional bank issues? We don't know. At the same time, it feels to me a little bit like pulling the hairnail off the finger as a time to buy in the streets. There's no blood in the streets, right? And if we could make it through the regional banking issue, why not this? Really, it's interesting you're talking about Nvidia, because I think what we need is just a little injection of something that creates optimism. So if you get a really good report out of that, you get the AI theme going again, I think we could rally out of this. However, we actually went defensive on our U.S. stocks, which means fully defensive, last week.
All right, what's a defensive stock for you mean? Is it a big balance sheet, lots of cash? What's it mean?
So, hey, when we say defensive, we mean defensive, like as in T-bills.
Oh, okay.
Right. So we have a bunch of different funds. We have an option hedged ETF, MRSK, that's always in the markets but hedged, right, with options. But we have a couple of funds too that can go fully out of the markets, and so those went out of the markets in T-bills. We can also be in aggregate bonds and other types of things. If those went into T-bills, that's purely just reactive to price trends. And so we don't know what's going to happen. So that's the perspective we bring, is that we have fun talking about the markets, but we can actually make huge shifts. So we don't care as much as the normal market player if things fall off the rails, because we can hedge against that.
You can understand, though, why the market's an optimism machine if you just look at any long-term chart of, the Dow or the S&P 500.
Yeah.
I mean, obviously, over the long term, it's going up and to the right. Do you think the other, 493 stocks in the S&P are going to start to catch up with the top 7?
Maybe. And, it was broadening out before we saw this little move down in the last 3 weeks or so. So maybe. But when I say optimism machine, it's sort of like a little different take on it, in the sense that as fast as you can go from optimism to pessimism, you can go from a great market to significant losses, right? And so I think everyone looks at the fundamentals and just puts so much weight on that. And, over the long term, that does weigh heavily. But it's really all about what sentiment is, what the vibe is. And you could argue that we shouldn't be as high as we are right now, and those 7 stocks shouldn't have led us where we are. But it is the way it is, based on just market momentum. And I think 15% year to date on the S&P is still awesome compared to those T-bills that we just shifted into last week. And so that could be enough if we just go bring it up another couple percent and see the market take off. It could be enough to get us back on the road again.
The cool thing about treasuries is if you get in, at a great rate, and what are you getting on the T-bills, like 5%?
Yeah, sure. Yeah.
I guess in that sense you have reinvestment risk, but if you go a little bit out the curve, you could top tick the rate. And so not only are you getting a decent return, but you're going to get capital appreciation, right?
Totally. And I think there will be a day for that. I'm not sure it's right now, though. I'm not sure I love that trade because just, if we don't hit it into a recession and the market normalizes, the yield curve normalizes, I think you're still sort of where we are on the 10-year potentially. So
don't we have to get into a recession? If the Fed really wants to control inflation, don't they have to push us into a recession?
That goes back into the optimism machine question. It's like so many people think maybe it's not going to happen now. So,
come on.
Look, it's the one thing that's interesting is it's so hard to make these market calls, these economic calls, because so many times, over the last 10, 15 years, something seems obvious and then it goes the other way.
But know the four most optimistic words in the English language.
What are those?
It's different this time.
Oh, yeah, of course. No, I get that. I get that. Yeah.
All right. So what's the catalyst, or catalyst plural, that would take some of that 90% of your assets that's in cash now and deploy it into this?
Okay.
market?
So all it would take is a trend higher, right? So get good Nvidia earnings, gets enough. Maybe it's not so much what good news could happen, but whether we see receding bad news, especially out of China. And it's hard to make the connection between all this bad news and shadow banks and everything in China and how it could actually impact U.S. investors. And I think that's what we're all waiting for, right? Because the credit crisis, it's all about things that seemed like it's not going to really affect the markets broadly, and then all of a sudden it totally does, with the financial crisis, everything else like that. So I think, some good earnings, see the 10-year stop going higher,
Yep.
we're at 432. If we could stay there, I think that could potentially be enough. Okay, we've got bad couple of months seasonality coming up in September and October. So maybe we have to wait.
I remember that.
Yeah.
All right. So, how about a pullback in this market? Is there a valuation call here? We just kind of got through the earnings cycle. We kind of got reset on earnings outlooks from a lot of these companies. What did you take away from the earnings season we just got through?
Well, I think it's enough to keep us going in the bull market. Like I don't think we weren't hit too hard in any particular place. So I think it's enough to keep us going. And so I'm talking really here, when I talk about where the markets are going, it's all really basically short term. I'm thinking about what the next 3 months, 6 months is, because that's all people seem to care about, right? There are much bigger issues. And I think China plays into that in terms of global debt. You've seen the movie Interstellar, where Matthew McConaughey's there on his spaceship, and
seen like 8 times.
There's what looks like a mountainscape in the background, and they figure out it's a giant wave.
Yes.
Okay, so here's the pessimistic Felipe coming out, which is that's still there, right? And these record global debt. The presentation I've been doing all across the country this year is the hidden implications of global debt. And so if you want to zoom out a bit, if you'll go there and not care about next month, I think those are some huge implications. And China, their wealth to GDP is around 8x. So the only time we've seen that historically is in Japan, back in 1989, the last time that they had a good stock market, right? And so that you have 3x in the U.S. And so bringing that demand supply equation back into balance, which means bringing wealth down and GDP up, that can sometimes be painful.
Hopefully not just right? Hopefully it could be leaving wealth there and bringing GDP up.
Potentially. Yeah. We can have a whole conversation about that because I've got like a whole hour presentation. I can make it into 5 minutes for you guys if you want. So, yeah.
All right. So
we don't have time now, but I want to see that presentation.
Okay.
When's the next time you're going to give it?
Well, so I do it in person. That's happening.
Oh, I see. We have to hire you to come into the office.
Yeah.
Right.
Yeah. That'd be awesome. Yeah.
All right. 30 seconds. Okay. The Fed, what are they going to do next?
Well, next Thursday. What are they going to do on Friday? Sorry.
Potentially. But I assume nothing there. So, but
that's what I think. I mean, there've been a couple times this year when I've said it totally doesn't matter what Powell says, and then he says something important, and the market's really changed. So I think I may have said that last time I was on with you guys. I think just like nothing burger is where we are in terms of because we're all expecting maybe another 25 bips out of the Fed. It's just not the same newsmaker it was over the past 12 months.
We got to turn that narrative around, because otherwise, why are we saying the whole surveillance team there?
Exactly. And Michael McKee's
it's going to be the most important Fed gathering that we've had all year long.
Whatever fish are out there, they're running, we'll call it that. Phil Toews, thanks so much for joining us. Phil Toews is the CEO of Toews Asset Management.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Claudia Sahm joins us here, founder and independent economist at Sahm Consulting, but she was all over the place. She was at the Federal Reserve, senior economist at Council of Economic Advisors at the White House, on and on and on. She's got PhDs from Michigan, not the Ohio State University, but Michigan.
Well,
she went to Denison undergrad.
That's
cool.
Most importantly.
That's most important because
I was
the great state of Ohio.
I was there for one ill-fated year, 91, 92.
Didn't work out for you.
No.
Did they ask you to leave, Mr. Miller? It might be better if you didn't come back.
It was I think a mutual agreement.
And it's under seal, and we can't go there. Claudia, I would like to talk to you about heat. It's hot out there, and not just in the southern and western part of the United States, but all over the world, it seems like. What does heat mean for this economy?
Right. So the Bloomberg opinion piece that I wrote was focusing on heat and its effects, and particularly its economic effects. Like, we know there's a lot of human cost to, heat waves and very high temperatures. And this instead was looking at, okay, what are the effects of this on the economy? And these can be, even if we're not the ones in a high heat area, it can affect us, right? If labor productivity is lower, growth is lower, costs of a lot of these goods, agriculture goods is higher. So the effects are broad-based. And when you start to go through the list of all the ways that high heat, rising temperatures affect labor productivity, it's a really long list. And there's a lot of variation, whether you're thinking about geographic, where Arizona and Texas are going to bear the brunt of this. I mean, they certainly, and there are effects this summer. Phoenix is the hottest city in the country, right? So, and there's also industry differences. Right, agriculture is hard hit, but agriculture is not the only place that workers are exposed to high heat. I mean, 20% of U.S. workers are exposed to high heat. So you don't have to do too much math to figure out if these workers are, having a rough time doing their work, it's going to show up in a measurable way in growth.
Well, no, construction. I was talking to some construction workers in Texas who said they can't do the work during the day. This was last month. They couldn't do the work during the day because it was far too hot. And then they try to do it at night, but they have, their noise issues in residential areas. So it really is incredibly expensive. And in some cases, they can't even get jobs done because when you're laying cement, for example, it's got to cure in a certain way, and the heat doesn't allow it. In any case, it's not the only effect of climate change, right? The storms, the massive storms that we're seeing, the wildfires that we're seeing also have an effect, and that just builds up the costs on the country. Is this just, I guess, a new normal, a worsening normal that we have to get used to?
Right. So there's a lot of arguments about why we have this high heat, why we had these droughts. And regardless of whether you get into the climate change debate, which will get you to this problem will get worse, like right now we are seeing costs because, as you said, there's high heat, not just in the US, Europe has really struggled with this also. And so it's like these costs are here right now, and to the extent, like you were saying, the construction workers, we can only adapt so much, right? And then it really starts to bite on productivity, and we see it in a lot of places like food. I mean, we see this already a lot of times.
And we see it like within cities. So I'm looking at your opinion piece here. In Washington, D.C., there is at times a 17-degree difference between wealthy and poor neighborhoods in Washington, D.C. How does that come about?
Well, and I mean, I double checked that number several times, right? Like that's just, wow, 17 degrees, like that's a big difference. So what happens in a lot of cities is you get these heat islands, right? So in poor areas, you don't have the trees, you don't have, the grass, the wider spaces to kind of absorb that heat. Instead, in a lot of these lower income, it's just, you've got the, concrete, the buildings that absorb the heat and then push it back out, right? And so that can make a big difference in terms of, these heat islands can be much hotter in some places than others. And then it's like, well, what makes a heat island, right? It's this lack of vegetation and all of this. So that's there are lots of ways that this high heat creates disparities across those with less income and those with more.
Yeah, I know like here in the metro New York area, whenever they put up the maps on TV of the temperatures, it seems like always the highest temperature is Newark, New Jersey. by like 3 or 4 degrees relative to everybody else.
Really? What about Midtown?
No, it's Newark. It's
Wow.
always, and I don't know why, but the poor folks there have to deal with that sometimes.
Any case, it's a great piece, and I recommend if you have a Bloomberg terminal, type OPIN GO. If you are on the internet, you can just go look at Bloomberg.com and search for Claudia Sahm. Claudia, I want to get to the Fed because your Sahm Rule has become famous with 3-month moving average of unemployment when it rises by 0.5% relative to the low point during the previous 12 months. That means the economy is contracting. How does it look to you right now? We're not in a recession, but are we headed for that?
So the labor market is pretty strong still, right? Consumers are still spending. That's almost 70% of GDP. So it's pretty clear that we are not in a recession right now. I think some of the conversation in Jackson Hole, the decisions that are made by the Fed over the coming months, I mean, that could have a real impact on whether we go into a recession or not. The Sahm Rule says nothing about where we are headed. And there's been a lot of indicators that normally are pretty good at saying a recession is coming that are really flashing red. I think they're too pessimistic, but they're, not being in a recession now is no guarantee of not being in a recession end of year going into next year.
Well, do we have to get into a recession in order for the Fed to really control inflation? Is that a necessary part of getting inflation, the inflation genie back in the bottle?
I firmly disagree with the idea that we need a recession. And that messaging has been very clear from the Fed officials. Right? We don't need one. We may get one. And if we get one, we may see inflation come down a lot, but that does not mean that we need one or needed one if we get to that place. The special factor this time is we are unwinding a lot of disruptions in the economy from COVID. I mean, that's what a lot of the disinflation we've seen this summer is coming from. That's really giving the Fed an assist here, right? It also makes their job harder to figure out how much they need to do. But if the stars all align, and they could, we have the ingredients, we don't have a contraction, or it's a very mild contraction.
And that's kind of where I think a lot of folks are, because they just look at the employment environment, and we're still at or near full employment. How do you think about the labor market?
Right. So I found it fascinating that over the past 2 years, the markets have kind of like, a recession is coming. It's not coming. When's coming? So we move back and forth. I've been steady in the call. This is very important with the recession,
Yep.
Where we're headed. And I think, the Fed tells everybody they're data driven, right? So I can't fault anyone for looking obsessively at the data.
Right.
And yet one release of inflation, or like, this is not going to tell us anything. And with the labor market, the tide can turn pretty fast.
Yep.
Right? Like again, there's no guarantee that we stay here. But I mean, my goodness, this has been a good labor market for workers, particularly low income or low wage workers.
Yep. All right, Claudia, thank you so much for joining us. Claudia Sahm, founder and independent economist at Sahm Consulting.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Matt Miller, Paul Sweeney here in the Bloomberg Interactive Broker Studio. Look at this, Matt. The Bankrate.com U.S. home mortgage 30-year fixed national average, 7.55%. I feel like a rock star with my 6% mortgage.
I'm surprised it's that low because we just saw the 10-year rise to 4.34, and we've seen the mortgage rate about 3 points above the 10-year lately. Right. I know that's more than the historical average. Usually it's more like 2% above the 10-year, but...
Let's bring in a professional who does this stuff for a living. Lisa Nee, national leader of real estate practice at EisnerAmper, joins us live here in our Bloomberg Interactive Broker Studio. What's the world to do with a mortgage rate of 7.55%? I mean, Matt's got his under 3. He's not doing anything.
So thank you for having me. Great question of where we're sitting. When we look at historic mortgage rates, we talked about this before, when I first bought my house 20 years ago, that was about what my rates were at, or about the 7s.
Yep.
And so when we look, we have some very, very artificially lower rates over the last 10 to 15 years. And so it's not really the mortgage rates, but it's pricing and figuring out what valuations are at. And that's really where the trick is. What are the values? We talked about supply. So because there's such little supply out there, it's going to be a little bit hard for people to understand and make those financing work with those mortgage rates. So if you're below 7 and you need to sell and move, there's really very little that you're going to go to pay a higher rate going forward. And that's where the supply is really going to hurt people who are looking to be first-time homeowners.
And most everyone's below 7. I mean, people have, what's the average right now? It's got to be between 3 and 4.
Probably, yeah. And it's going to be difficult to compel someone to sell their home to move to get something at a higher rate.
So what's the rate? I don't know. Don't want to call it a break-even rate, but what's the rate where you think the market frees up? That buyers say, "Oh, okay, I can stomach this."
The great reset is what we call that.
Is that what it is?
I mean, because so many people are holding on to their homes.
Yep.
They can't come to an agreement on price, right? Because if you want to buy my home, I'll sell it to you. I have a 3% mortgage, so I'm going to sell it to you for a hell of a lot more than I would normally ask. But you're not going to buy that because you need a 7% mortgage. So there's no movement, right? Yep. And Bloomberg, we call that the great reset here.
That's exactly right. And it's also figuring out what the real valuation is for your house. And so you think it's worth well and above what it should be because the numbers aren't penciling out based on those mortgage rates. So you want that cash buyer, that unicorn of the cash buyer, and be able to have them come and purchase your home. But again, it's you figuring out what you're willing to take for you to have to pay off your mortgage and move somewhere else, knowing that you're not getting that rate again.
Yep.
Well, I mean, so where are we, like, statistically? Is this like a abnormally low time for lack of transactions?
The transaction market, not just in the home mortgage, but in every commercial real estate, is at a standstill because people are trying to figure out where mortgage rates are going to be in the 10 years. So you mentioned it was 4.3. And so figuring out how long it's going to stay there and when are values going to start coming down. And then transactions should start picking up based on that. But until people really understand where values are going to be and we're sort of at that set, it's going to be difficult for transaction volume to pick up.
So we haven't seen, like, what I want to see is one or two kind of notable transactions in New York, for example, or San Francisco. And I want to see if the discount is 10%, 30%, 50%, 60%. I don't know where this market is for some of these big markets on the commercial real estate side. We haven't really seen much transact, have we?
The only thing we've seen is giving back to the banks, which we know didn't make smart investment sense for people to go, work those properties back in. And things that are going to start trading soon, it's not trading because there's no cash flow there. It's trading because the mortgage rates aren't working to pencil out those deals. And they just haven't happened yet because right now we're waiting for those mortgages to be up. We talked about, when are those fixes? Is it in 18 to 24 months? And that really might be the cycle of what we're looking for to see when those tradings are going to start happening.
What about building homes? I mean, are we bringing enough supply on in that way since there isn't enough supply in, previously owned homes?
So, correct, there wasn't enough supply in 2007 and 8. We stopped building homes, and so now there's a little bit more. But what they're doing is single-family rental because people aren't able to purchase their own homes. You now have these large companies who are coming and building single-asset homes or single homes, and people are renting them with the hope that they'll be able to buy them and build up their credit rating in the future.
But
that's
by the way,
in the Sunbelts.
There are a lot of people who will say, I don't want to buy a home. In fact, the cost of ownership, I think, is higher than most people realize.
Taxes.
A lot of times, rental is, taxes. Tell me about it in Westchester. There are a lot of people who say, look, I'd rather rent a home, and it's actually a better financial decision. I can invest my money elsewhere, and I'm better off.
And when you think about the generation now that's looking to buy homes, they're not looking at long-term thinkers. They're in the 1 to 2 year range. And so for them to purchase a home that they're going to be in for 30 years when we did our 30-year mortgages, they're not looking at that. They're looking for the 1 to 2 years where they're going to live and not really want to commit to something for that long-term purchase. And that's why that the single-family rental market is so hot right now.
How much of a problem is it going to be on the commercial real estate side when mortgages come due? I mean, because we've seen people like Brookfield. I mean, like major institutional real estate people turn the keys over. I mean, this isn't some mom and pop developer or owner. These are major global real estate players that are just saying, I just can't make it work.
So what they're bringing, why they're turning their keys over is they're making sound business decisions of saying, I can't have my investors, they have the cash to do it. They don't want their investors to invest back in to make those properties work, knowing that those have to be reset at a lower price per foot.
Reputational risk there? I mean, you're a failure. You just turned over this trophy property in San Francisco to the banks. Now it's the bank's problem.
So they're making sound investment decisions of saying, I can't
Well,
pencil
from the
out
bank,
those
it's not
numbers.
sound to me.
Well, so when I mean, that's a fair point, but the banks are going to sit there and they're going to make sure that they work that out, and they're going to all make sure that those properties get repositioned in a smarter way, probably at a price that makes sense for that new developer to come in and reposition that property. So it is a sound investment decision if you're an investor from a Brookfield point of view.
It's going to take years, isn't it, for this commercial real estate market to sort itself out?
We at least need to see what's going to happen in the next 18 to 24 months. And when you talk about costs, the biggest cost people are complaining about besides interest rates is insurance. And that insurance market is really putting a strain on the pricing that's been coming up for people to make sure that they can make those deals work and pencil out. The percentage of insurance going up year over year has been astronomical from what we're hearing.
You know, people make a lot of money in real estate, commercial, residential, but man, when it's bad, when the tide turns, it is tough out there because everything conspires against you.
Yeah.
Lisa Nee, thank you so much for joining us. Lisa is the partner and national tax leader for real estate practice at Eisner Advisory Group. And change your name. Okay, Eisner Advisory Group. Good stuff. All right, but you're sitting on your 3% mortgage. You don't have a care in the world.
Well, also, I can't move. I mean, I have a 2-year-old and one on the way, and a wife that would kill me if I even suggested it.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Now Sri has darkened the door of the Bloomberg Interactive Brokers studio. Let's find out what's going on here. Sri, it's not a huge unit, right?
It's not a huge unit, but this is again one of those strategic missteps that people keep talking about, ultimately, because you're talking about a business that was part of the core Goldman effort to get beyond its core base of ultra high net worth clients, go after the mass affluent market. How they did that, one, is obviously through that ill-fated consumer banking push, which has completely been, they're attempting to wipe it off the face of the earth now. But at the same time, even in its wealth management business, they wanted to go beyond their high net worth base because that's a place where Goldman's really good. They then wanted to go out there with this United Capital purchase to reach the market where your average customer balance size might be 1 million, 1.5 million, nothing like the $25, $30 million customers you normally deal with, but it was a signal that Goldman was going beyond its roots. Undoing that deal 4 years after it's done is a clear admission that didn't work out, and it wants to refocus its energies to places where it's really good at. So again, another circuitous path to get to the place where they were already standing 4 years ago.
I've been a key admirer and competitor to Goldman Sachs for 40 years. So to me, the only story I care about now is just David Solomon, the infighting, the partners, or whatever's left of that partnership. What's it like in the hallways and the executive suite of Goldman Sachs these days, do you think?
It's
or the Hamptons, God forbid they're in the office.
It's funny, and I'm glad you mentioned the Hamptons, because just last week there was an event where Gary Cohn was there and the founder of BTIG was hosting it, and he starts off
Nobody was wearing socks, apparently.
That's right down your...
No socks.
They were all Hampton chic, so yes, Matt is right.
No
one was
socks
wearing
on Cohn, no socks on Larry Summers.
But here's the thing, like the host, the BTIG founder started off by cracking a joke saying, hey, if you see Gary Cohn leave, that's because he's being called back in to be a candidate to be CEO. They're all openly joking about it. So the atmosphere inside Goldman Sachs is obviously not great. But I will say that a lot of the criticism has been brushed away like, oh, it's just personality issues. People are not happy with a hard-charging boss. But there are also some genuine operational mess ups. The Economist had a very good story over the weekend. It is not like Goldman performance has been dreadful Absolutely not. That's not why the stock would be up 50% over 5 years. At the same time, it's not been great. It has been patchy, and patchy is just the right word. You've had successes in places where you're really good, i.e. investment banking and trading. Everything else, you fumbled with the leadership in asset management. By my last calculation, I think they had like 7 different iterations of leadership in that asset management business. We've talked at length about all their problems with Marcus. So clearly on the operational side, they've had some challenges, and that contributes to the air of discontent inside Goldman Sachs.
They don't have too many problems with Marcus from my point of view, because I get 4.5% on that account.
But all right, one of the things I want to ask is, what's the role of Lloyd Blankfein? I always think about the past chairmen of CEO or CEOs of Goldman Sachs and what role they play, given that it was a partnership for so long, given that partnership mentality, the cliques of partners still exist there. What role does he play these days, or is he kind of in the background?
It's interesting you mentioned Lloyd, because all of the reporting around him in recent months has been how he's been a little more open and has been griping about David Solomon's performance. But in reality, I don't think what Lloyd is saying really holds a lot of weight with current management, or for that matter, the board. But he is, if the griping is indeed true, he is expressing a sentiment that's been echoed everywhere inside Goldman Sachs. People who interact with Goldman Sachs, they're all talking about the same topic. Even when they meet some of their biggest clients, those clients tell us that, they start their meeting, or at least half their meeting ends up being a little bit about the palace intrigue inside Goldman Sachs rather than the business at hand. And that's obviously a challenge. They need to solve for that. They need to make that noise go down.
It's interesting because I do look at the MGMT function on the Bloomberg terminal for Goldman Sachs, and I wasn't aware of this, that David Solomon is not only the CEO, he's also the chairman of the board. So he has a strong a strong position structurally in the company.
Absolutely, and that's how a lot of American bank boards are structured. It's very different in Europe. The chairman typically does not tend to be the CEO. In the US, that often is the case. Look at JP Morgan, look at Morgan Stanley, look at Goldman Sachs. But I think the direction of travel, and in the coming years, you will increasingly see a split in those roles as well.
I'm looking at this board. The lead director is Bayo Ungulesi, who I do know because he's from the Credit Suisse First Boston days. He's a longtime global banker with a lot of heft as well. So.
Used to run the investment bank at Credit Suisse, has a lot of great credentials in the finance community, has done really well with GIP, Global Infrastructure Partners. And interestingly, he's been the chairman even before David Solomon arrived in the CEO seat. That is, when, not the chairman, the lead independent director.
Yep.
So when Lloyd was there, Bayo was the lead independent director and has held on to that role under David. So in some ways, one of the more powerful but underappreciated roles in finance right now is the lead independent director at Goldman Sachs in a time of tumult.
There's so much news there's so much kind of M&A news in finance this morning, right? Because you're a Goldman story. You've got the Citi institutional client group split.
I'm going to watch that. My boy Tyler Dixon's one of the top guys there.
You've got what kind of looks like a bidding war over Sculptor, if it'll be allowed, because it seems like the game is rigged there to keep the current management in place.
This Sculptor thing is just endlessly fascinating. When you heard about the guys who were looking to buy them, Clear Lake, I believe, fine. We knew Sculptor had been pushed to look for buyers. So it's
Sculptor Capital Management.
Right, and previously more famous as Oxif.
Yeah. Oh, okay.
Oxif
all right, so
was
this is alternative manager?
Right,
hedge
the classical hedge fund, right? But and we saw, okay, fine, they had a deal, and normally that's the kind of roll-ups we've been seeing. But the fact that you have this all-star lineup of Boaz Weinstein, Mark Lasry, Bill Ackman contemplating a counter bid or putting forth a counter bid, it's so interesting. Obviously, Sculptor's not taking the bite just yet. We will see how that unfolds, but yeah, it's interesting to see this bidding war on that Oxif, now known as Sculptor.
Yeah, because usually that community is so tight knit. The hedge fund community wouldn't see something in the public, but it's at a 52-week high today. It's up 3.6%. Sculptor is SCU is the ticker, and it's got a market cap of $725 million.
And the backstory is important, right?
And fascinating.
Oxiv became sculptor after having gone through a pretty bruising battle and some investigations over a bribery scandal. And of course, there was the whole leadership fight between Jimmy Levin and Dan Ock, who's no longer doesn't have an active role, but clearly still a big shareholder.
7.8 million.
And
shares,
they became sculptor. And I'm telling you, the only thing that'll be better than this lineup of alternate bidders that we've heard of is if suddenly Bill Ackman and Carl Icahn decide to join forces and bid for sculptor.
Join forces or fight over it. And plus you have the whole...
We'll take either of those options.
The Dan Ock saga, right? Because this is a guy who, like, builds himself up and then destroys himself over and over again. You know, he's like, how big can I build this? And then he's like, how can I ruin it in a dramatic fashion?
And talk about palace intrigue. Jimmy Levin was the chosen one. He was Dan Ock's guy. He was the one who was supposedly going to be the one running the place, and Dan was completely behind him. And then this breaks out into this all-out war between the two of them.
All right, so we'll pay attention to that. I like seeing the hedge fund guys battle each other. Again, another kind of like billionaire story. Billionaires acting oddly, silly kind of stuff.
Fighting about a crab shack on their
inches,
property,
right.
Or someone's modern art statue that's an eyesore. Or
right.
Did Bill Gross reportedly he played the Gilligan's Island theme song over and over again as loud as he could?
Fight with his neighbor. Yeah,
Yes.
How could we forget that one?
I love it.
Billionaires behaving badly. Shri Natarajan, thanks so much for joining us. Wall Street reporter, Goldman Sachs reporter for Bloomberg News, joining us live here in our Bloomberg Interactive Brokers studio.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Matt Miller, Paul Sweeney, live here in the Bloomberg Interactive Brokers studio. We are streaming live on YouTube, thankfully, because then our viewers get to see Dan Ives in person. Dan Ives, senior analyst at WedBush Securities. And you're a sell-side analyst, Matt. One of the challenges is kind of standing out from the crowd, making some calls that really stand out. This call stands out, and this is a call I fully endorse. I've been calling for it a long time. I get ignored the whole way. Apple should end deal drought by buying ESPN. This analyst said that. Dan Ives, managing director, senior analyst at WedBush Securities. So, Dan, I kind of agree with you here. What's your rationale behind your call saying Apple, which is a company you follow and have followed for a long time, should buy ESPN, which may be up for sale?
Yeah, and I think, look, 18 months ago, this isn't even a discussion. But I think if you look what's happened with Iger and Disney, with the strategic process, I think now ESPN, in my opinion, it's a matter of when, not if. That ultimately Apple is going to look to, at a minimum, do a distribution deal, and we believe potentially acquire ESPN. Because you look at what Apple needs, they need live sports content. I think MLS, in terms of the Messi situation, that's really whet the appetite. I think they've now recognized, and you see the subscriber growth that's been massive, that's what's going to bring them onto the platform. Pac-12 clearly came and gone, and that was something that they were trying to get, and that deal fell apart. But when it comes to live sports content, it's the golden goose. So we ultimately believe that in the next, call it 6-9 months, Apple finally can end this deal drought. Obviously not M&A that's in the typical DNA of Cupertino. And I think ESPN ends up in Apple.
Why stop at ESPN? Why not just buy Disney? They have more money in cash than Disney has in market cap, total market cap.
Yeah, and I know. I mean, others talked about Laura and others about them buying Disney.
Laura Martin.
Laura Martin from Needham. Yeah. I don't personally see that. Just because when it comes to parks and it comes to the rest of the Disney operations, that wouldn't necessarily be within the strategic DNA of Cupertino. When you look at ESPN as an asset, that's something that fits like a glove in terms of in the broader strategy. So I think Disney itself, I put a very low likelihood. But when it comes to ESPN, I think high likelihood that something happens here. Look, Iger and Cook are, know each other extremely well. These are two companies that have interoperated, extremely well. And it's something when it comes to ESPN, this is something to me, peanut butter and jelly.
What about the antitrust issues? Because regulators don't even want to allow Apple to control what it does with its own store that it invented for its own phones. Like they're not even allowed to run their own business in a free country. Why would they be allowed to buy ESPN?
Look, every week there's just another black eye for Khan and the FTC. So it just comes down to, I think, big tech recognizes more and more starting to get their oats. In other words, I feel like it's getting to a point where you're now starting to see, I think, more and more of a potential opportunity for M&A. When you look at Microsoft Activision, you look at the constant battles that the FTC has lost, I don't think that's something that necessarily makes them nervous. I'm not saying that this is going to be easy to get through, but when it comes to Apple, that install base within Cupertino, that is the deal that I believe just makes a ton of sense. And I think many within the industry more and more are talking about.
You mentioned the deal they did with to get Messi here to Major League Soccer. What was that? I forget. Like, how did that work out?
I mean, ultimately, there's going to be a part. It's essentially a part rev share, right? That Messi's getting. And it was like,
and Apple's allowing Messi to participate in any growth.
Without Apple, Messi is not at Inter Miami.
Yep.
And I think and I think that's something where when you look at Messi coming, what that's done in terms of subscriber growth to the platform, it shows because look, as much as Ted Lasso and some of the cameo and the content on Apple is obviously phenomenal, right now it's a mansion with not that much furniture. Live sports content where it's at.
All right, so
not to mention, I mean, or despite of the fact that, in spite of the fact that soccer is just boring. Just to tears.
ugly American who lived in Germany for...
well, compared to football or basketball, you like soccer?
Look, personally, I mean, I could watch soccer, but obviously the drum roll into what I view as college football, it's the mecca. It's the mecca we are.
All right, let's talk Penn State football a little bit. We'll digress. Preseason rank number 7. I love that rank, but boy, that feels high.
Oh, I think this is probably one of the most elite defenses in all of college football. And in my opinion now, with Allar at quarterback, this is something...
Now, you believe in this guy?
I truly believe. I think Franklin's put it together. And look, when you look at Big Ten, you got Penn State, Ohio State, Michigan, which are all going to be 3 of the top 6 or 7. And I believe the torch slowly is being handed from SEC to Big Ten.
Boom, there you go. Now our boss is... I can hear him walking down saying, get off this discussion. All right, let's step back again on Apple. The iPhone 15, is that the next one in September? Do I upgrade? Because my battery is already starting to bug me, so now I feel like it's an upgrade time.
What do you have, an 11 or something?
11.
Yeah,
but your situation, actually, if you look at it today, take a step back, you have 240 million that have not upgraded their iPhone in 4+ years. Now, battery life was phenomenal. So many were kind of like Paul. Like, you had iPhones maybe 3-4 years. I think we're now getting what's going to be
3 or 4 years. Didn't Apple purposely set up the iPhone so that the battery would die right at the end of the 24-month period?
And again, that's,
it's an old wives' tale.
Is it an old wives' tale? Haven't they agreed to pay money to settle that?
Now, look. That's something where obviously there's water under the bridge. But when you ultimately but it does speak to what right now when you look at Apple as a stock, I think this is sort of halftime in the Super Bowl, going in to what I view as a massive cycle. And even in China, despite all the noise, they're gaining 300-400 bips of market share, which is why we believe Apple here is a table pounder on the pullback.
All right, so we got you here in the studio. We got your Apple call. Give me us 2 or 3 more of the calls that you're talking to your clients about these days.
Look, the guidance heard around the world is going to be Wednesday night with Jensen and Nvidia, because this is, I'd say it's probably one of the most important earnings calls in many, many years for tech. Because it all comes down to the godfather of AI. When you look at Jensen, Nvidia, they see the demand, they see the use cases. I'm expecting bullishness Wednesday from them. And I think that's important for the rest of the tech sector that we're going to see across the board. And then it kind of parlays into what I believe is a key theme is cybersecurity. You saw that Palo Alto Friday night, a lot of fears about that with the Friday night special. Right. That soap opera's done. I wouldn't expect them to be doing any calls Friday night, but that was much better than feared. And I think it just shows that demand's holding up well in cyber, in cloud, in chips. We think the new tech bull market is already begun.
All right, so the way you play that is Nvidia. Microsoft's also
well, maybe ARM Holdings, right?
Oh yeah, what is
that going to happen?
Give us. We got 2 minutes left, 2.5 minutes.
It's a private company now, owned by SoftBank.
Yep.
But Nvidia wants to push that IPO, and so do other big players. Is it going to happen? Are we going? I think we're going to get the filing today.
Yeah, I mean, I think right now this is something the street's highly anticipating because it's all how do you play these themes? And you look at ARM, you obviously have big players, SoftBank and others in there, and I think it's something where this is the biggest tech theme, in our opinion, since 1995, since the start of the internet. So we are, despite what we're seeing in the macro and everyone focused on every Fed sort of meeting or every dinner where they give some speech, the reality is that that white flag's starting to get raised. It's a risk on, and in my opinion, it's the biggest tech trend we've seen in 30 years.
So is it fair to call ARM an AI play?
Oh, yes. I'd clearly be able to call that an AI play. And Paul, Matt,
man.
I'd say the difference now is that NVIDIA right now, they're the only game in town. But when you look down the road, you got SUE and AMD, you got ARM holding, you're going to have other chip players in what's really going to be a tidal wave of spend.
All right. What else you got for us?
Look, I'd say overall, this is something where I think more and more investors are focused 2024. I think if you look at names like Tesla, we've obviously had a pullback post earnings, a lot of worries about price cuts in China. We think bark's worse than bite. 95% of that is already in the rearview mirror. And I continue to view it in electric vehicles. It's Tesla's world. Everyone else is paying rent. But you are going to have, look what's happened in the 313 area code. And there's massive turnaround at GM, massive turnaround Ford, what Farley's doing. And it's the biggest transformation to the auto industry since 1950s.
Yeah, for sure. I mean, Volkswagen has invested overseas a ton as well. And we're getting... I'm driving the BMW XM right now, which is a hybrid, but I've driven the iX, which is very impressive. And they have a fleet of electric vehicles coming out. Mercedes has the EQS and the EQE. Those are very
and then exactly. And then
well executed as well.
Exactly. Yeah. And then you're going to have Paul with a Cybertruck next year going up to his tea time in that Cybertruck.
Absolutely. Dan Ives, thanks so much for joining us. 2 weeks until Penn State football kicks off. Dan Ives, Managing Director, Senior Equity Analyst, WedBush Securities.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
There has been talk recently about a new COVID variant.
Nope.
And I mean...
Not here, there isn't.
I think it's safe to assume that there's going to be a variant of this virus around for... Look, the Spanish flu was, I think, 1918, right? Yeah. And we still have variants of that floating around today that people kind of get every year. It's not a big deal. It's just how it works. But it could be a problem for the companies that made the vaccines for the OG variants. Sam Fazeli joins us right now, head of European research and pharmaceuticals analysis for Bloomberg Intelligence. Sam, great to have you on the program. And I want to say that, first off, people don't have to just listen to this program. No. You can watch it if you go on youtube.com, search Bloomberg Radio, and we stream live. You were already an attractive man, Sam, but now with the beard, I would say you're at least 40% sexier. Do you get a lot of
thank you.
A lot of compliments on that?
You know, that means so much to me. If you hadn't said it, I mean, you've just made my day, basically.
Well, I do not.
I'll give you a hug when I see you.
I do not support this move to a beard.
I love it.
You know.
All right, so talk to us about
when I see you.
Talk to us about the possibility. I mean, obviously, there's going to be a new COVID variant, right?
Yeah. Look, I'm scared of Paul. I'm even more scared of you. So I thought very hard and long about writing another note on COVID because the world has moved on, and rightly so, because our death rates are a lot lower. We have vaccines, we have drugs, we have everything. So why did I do this? Because I'm interested in the companies that make the vaccines. We have 3 companies involved in the vaccine making. If you want to add Novavax, there's 4. If you want to add Sanofi, Glaxo, 5, etc., etc. Variants, what do they mean? Variants mean the more mutations they have, the more likely they are not to respond to that initial shield that our vaccine gives us. So, and that initial shield is just simply the 2 or 3 months worth of protection against an infection. And this new variant that has just cropped up in some sequences, BA spot 2, spot 86, is the one that has got me a little bit worried, just like Omicron did when it first appeared, because it has 34 mutations. Now, that means if it takes hold, and nobody knows whether it will or not, that it could be a variant that would not respond to our vaccines.
So, Sam, what are the companies telling you guys about any further boosters or vaccines that may be available this fall? What are they telling you?
Yeah, so they've all, Paul, been making vaccines against the XBB variant, which is what the regulators asked them to do. That's the data they presented. That was the variant that was mostly responsible for infections in the past few months. Now, the issue is that, as I said, this new variant, if it takes hold, that's very important to say, because we don't know whether it will or not. It's as 34 mutations, amino acids different. So it's very likely that our antibodies won't do as well with them. We will still have great protection against severe disease as we had with Omicron in most cases. So what this means is that if they have carried on with XBB and say in a month and a half, this variant becomes, if it does, rampant in terms of, or the main variant or growing rapidly, that the vaccines just won't do a lot for that. And of course, that has to be tested. And if that's the case, then you have lower sales. Who wants a vaccine that doesn't do anything? And a higher stock write-offs. And that is not good, especially like for Moderna has already told us. They're going to have $3.5 billion to $4 billion of cost of goods manufacturing. You put that in the context of $6 to $8 billion guidance for sales. That's a humongous cost in terms of margin, gross margin, or gross cost at least. So it would be a really difficult situation for them in terms of managing this.
In terms of us getting sick, I mean, most of us have already had COVID once or twice, right? So how strong is our naturally developed immunity to new variants?
Yeah, so that really does depend on your age, your immune status. So there are, of course, people who are very elderly, so they do need a booster. There are people who are immunocompromised, who will always need protection from drugs or antibodies. Unfortunately, we don't have the antibodies anymore. For the average person, and I count myself as an average person, even though, as you can see, I have a slightly white beard here. We're all around the same age, Paul and I. You're obviously decades younger than us. We're likely to be okay. Now, of course, we all have a risk of long COVID or slightly longer response to the virus, but we should mostly be okay with what we've already had. Really, the majority of people don't need another booster shot. It is those people who are most at risk, whose immune systems are not as adept at dealing with rapidly changing viruses, who need the most help.
But the same is true with the flu, right? So this is becoming more of a flu-like risk.
Yeah, except, there's no flu around at the minute, at least in the Northern Hemisphere, right? And then we have a wave of COVID. You can tell, without needing tests and all that, if you look at the prescriptions for Paxlovid in the Bloomberg terminal, which you can look at if you had one, you can see that the prescriptions are going up like that. That tells you that community infections are on the rise and that people who need Paxlovid are hopefully getting them. But obviously, a lot of physicians are still worried about some nonsense called Paxlovid rebound, which has nothing to do with the drug. That is where you can see that there's clearly in August, because maybe it's too hot, people are all congregating inside. That's what happens in the winter. So this virus is behaving a little bit differently still. We're only 3 years into it, right?
So, Sam, how about for the companies and the income statements for the Modernas and the Pfizers of the world? Where are they in terms of transitioning away from, I guess, the reliance on these COVID drugs and to just the normal course of business?
Yeah, Pfizer, obviously, Paul, we have to put Pfizer aside because they have a $60-odd billion guidance for 2023, of which only about 30% comes from Paxlovid plus the vaccine. Moderna and BioNTech, that's pretty much their revenue line today. Okay. And I think that's going to stay the case for BioNTech, certainly for the next foreseeable, and Moderna possibly into 2024, 2025, when their other vaccine for respiratory syncytial virus is likely to kick in a very competitive market.
Yeah, looking at the Pfizer stock, that's come down very hard from its high here. So what's the kind of...
They need a fat shot. They need Wegovy or Ozempic.
Oh yeah, we need to get
No,
you
they
back.
need the opposite. They need something to fatten the share price, not thin it out.
Exactly. All right,
No,
next time
I
we'll
think
get you on,
they
we'll
need
talk
it.
about some of those weight loss drugs because they are all over the place and all over the news. Sam Fazeli, he's head of European research, is also the pharmaceuticals analyst over there for Bloomberg Intelligence. He is is our go-to guy on all things pharma, including during that time of the pandemic, and we were all getting up the learning curve of the disease and of, more importantly, the vaccines, which have been so effective.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's get to cars right now, seeing as Pebble Beach kicked off last week, and it's, I guess, a mecca for anything from classic cars to brand new cars. Ford, for example, unveiled their 800 horsepower Mustang GTD. And there were a number of other unveilings, but I think really it's all about the collectors in Monterey. Dave Meggers joins us right now, CEO of Mecum Auctions. Dave, thanks so much for coming on to the show with us. Talk to me about your take on the, what do you call it? The
Concours d'Elegance.
Concours d'Elegance, and what was seen out in California this week.
Well, Monterey Car Week is the mecca for car collectors every year, and everybody looks forward to coming to Monterey. All of the major auction houses are there. Of course, the concours took place yesterday. All manufacturers have some kind of a display there as well, and it's just a great place to be if you're a car person. And last year, Car Week roared back from a little bit of a hiatus because of the pandemic, and I think this year what I saw was the enthusiasm continued to climb, and I would say this year Monterey Car Week was back in full force.
Yeah, it's funny, Matt. My number 3 offspring, who's now 25, when he was a teenager and even younger, he's a car nut like you. He and his buddies would sneak in to the Del Monte golf course at the Hyatt Regency, where they have all these cars out on the golf course. It's just amazing, and it's great stuff.
Yeah, of course, that Del Monte golf course at the Hyatt is the Mecum auction, and
that's right.
We like to think that's the best auction on the peninsula. It's a beautiful display. This year we had 600 cars that were all displayed out on the golf course on the fairways. That's always a great look. We're the only auction company that is able to display out on a golf course like that. And we had a great collection this year that had 7 English cars, 7 Porsches, vintage Porsches, and 13 vintage Ferraris. We called it the Veloce Chanel Fast Collection, which translates into fast, fast, fast.
Yeah.
And that collection was
Italian, German,
gorgeous.
and English. So
Yeah.
what did you guys, what were the notable sales? What would you say the biggest that stand out for you?
Well, I think my observation was across the entire peninsula for the week, I would say the key word was Ferrari. There were a number of significant Ferraris that were on the peninsula, a lot of them for sale. Mecum was no exception. I think 4 out of the top 6 cars that we sold were Ferraris. 2 of them in the $3 million and over $3 million range, a 66 Ferrari 275 GTB, 6C alloy, and a 1990 Ferrari F40. Those are always significantly popular. And I would suspect that when all the numbers are in, we're still counting and we're still selling, but probably 7 of the top 10 cars at our auction that sold will be Ferraris.
Hey, Dave, give us a sense, because I didn't really know about this whole world until I started going to the concourse and to all the shows all around Monterey, and it really is a special time. There's something for everybody out there. Give us a sense of how the market is now in terms of the demand, the pricing, the value, because I know these are very substantial investments for a lot of people, and they look at them and they treat them just like they would their stock or bond portfolio. Talk about this as a marketplace.
Yeah, well, first of all, there are 2 types of collectors. There are those that collect because there's some emotional or personal attachment to the cars that they have in their collection. And then there are those that are purely transactional, financial, making investments. And of course, the collector car market has shown significant returns as an alternative investment over the last 10 to 20 years, averaging over 30% return per year. And of course, some brands doing better than others, Ferrari, of course, leading the way. But the market, I would say the last 2 years since coming out of the pandemic, has been absolutely red hot. We've been seeing 30% increases in prices annually, if not more than that, for certain select cars. And it truly has been a seller's market. I would say this year in 2023, we're seeing the prices not accelerating as fast as they have the last couple of years, which is beneficial, of course, to buyers and collectors. And my observation is right now we have a nice balance. It's still a great market for sellers. They're still seeing strong prices, but it's a little more reasonable and easier to catch the market, if you will, if you're a buyer as well. And that's resulting in great sales.
What data do you rely on, or what people do you rely on to help you set, the initial prices? I look at some cars, just from my experience as a kid who loved, for example, the Lamborghini Countach or the Ferrari 308, and there were times when they were going for $25,000, and then times when they were going for $250,000 and more. So who do you rely on, or what do you rely on to get the data to price these vehicles?
Well, as I'm sure you're aware, Mecum has been in this business for 35 years, and we are the largest collector car auction company in the world, selling roughly 15,000 cars a year at live auction for a little over $800 million. So primarily we rely on our own expertise and our own knowledge of the market. But all of the cars that come to our auction are consigned cars. We're an auctioneer selling consignment cars for collectors. And collectors have an idea of their particular collection or their particular car, what they believe that's worth. And of course, they keep abreast of the market for their particular area of interest. And we work with the collectors. We combine our expertise and their expectations to help them understand what we think the pricing is in the current marketplace.
Dave, it seems, when I spend a lot of time in Carmel and, during Car Week, there'd be people from all over the world and a lot of Italians in particular. Who comes to the Monterey Peninsula here in August for all of these auctions? It seems like it's an international affair.
Yeah, we'll do 16 auctions this year. And I would say of those 16, 3 of them are national events. Most of them are more regional in scope. Kissimmee, Florida, of course, the world's largest collector car auction in January, is a national and somewhat international event. Our second biggest event in Indianapolis, Indiana, is the Spring Classic in May. Again, international event, mostly national, but certainly not regional. Monterey is the one exception where I would say primarily it is international. Of course, there are a lot of U.S. domestic buyers and sellers. But just folks that I talked to over the last 3 or 4 days in interviews that I've done, from Germany, from France, from Italy, from Australia, from Great Britain, there are a lot of accents at the auction.
Yep. So is your market any predictor for the overall economy? Because here on Global Wall Street, Dave, we've been talking about a recession here for well more than a year. How does your market simply reflect what's going on in the economy?
Well, what we've seen, and this would go back to, I would say, pre 2008 even, and in some cases pre 1991 when we had significant issues in the economies before. What we've seen is that the collector car market is relatively resilient, and that's because, just anecdotally in my mind, when things are going very, very well, investors, collectors feel very secure in their financial environment, very flush with cash, if you will, and it's time to maybe use some of that to invest in something, in a collector car, something that I've wanted for a very, very long time. And conversely, when things are going very poorly, we see a lot of money that comes out of the market because of the uncertainty and the fear that's in the markets. And as money comes out of the market, that money's looking for a home. And as I mentioned previously, the collector car market has been a great alternative investment asset and you get to drive it on Sundays down to meet your friends. So a lot of money we see come out of the market goes into collector cars during that period. So I don't know that we in the collector car business are an indicator of what might be going on in the economy. And I would certainly say we are relatively resilient to what goes on in the economy.
All right, Dave, thanks for joining us. I know it's been a busy week you just concluded out there on the Monterey Peninsula. And for those car people out there who haven't been, it is a bucket list thing to do. It is a great week. Dave Major, CEO of Mecum Auctions.
Thanks for listening to the Bloomberg Markets Podcast. You can subscribe and listen to interviews at Apple Podcasts or whatever podcast platform you prefer. I'm Matt Miller. I'm on Twitter at MattMiller1973.
And I'm Paul Sweeney. I'm on Twitter at PT Sweeney. Before the podcast, you can always catch us worldwide at Bloomberg Radio.